cash do you have at the bank? Have you asked yourself, is that cash keeping you safe, or is it secretly shrinking? It might sound surprising, but parking too much money in cash can quietly erode your wealth, especially when inflation and missed growth opportunities are using the value of time to work against you. In this video, we're unpacking the hidden cost of holding excess cash, or what we call cash drag. We'll explore why many people may be keeping more cash than they need. Whether you're holding cash after selling a business, receiving an inheritance, or just waiting out the market volatility, this video will help you see how to protect and not stall your financial future. Hi, I'm Megan Miller, Associate Wealth Advisor at Towerpoint Wealth, an independent fiduciary wealth management firm located in Sacramento, California. At Towerpoint, we help our clients to remove the hassle of properly coordinating all of their financial affairs and grow and protect their wealth by making sure every dollar is properly aligned with their personal and financial goals. So let's dive in and first examine why many people hold more cash than they really need. For many, it's about comfort and perceived security. Cash feels safe, especially when markets are volatile, headlines are scary, or the economy seems uncertain. We also saw this after recent market pullbacks, political uncertainty, and during periods of higher inflation. People move to cash as a psychological safety net. It's also common after a big financial event, selling a business, receiving an inheritance, or cashing out a major investment. Suddenly, you're sitting on a large sum of cash, and the easiest, shorter-term decision is to leave it in the bank until you decide what's next. But here's what happens. While a healthy emergency fund is essential, anything beyond that can start working against you. We call this cash drag, and it quietly erodes the long-term growth of your wealth. Cash drag happens when too much of your portfolio sits in low-yielding cash or savings accounts instead of being invested. While that money may feel safe, it isn't growing over time to keep up with or ideally outpace inflation. Here's an example. Imagine you keep $500,000 in cash, earning 2% annually for 10 years. Over that same period, a balanced, diversified portfolio historically might return closer to 7%. The difference, roughly $375,000 in lost growth over the long term. That's money you never see because it wasn't invested and it wasn't compounding. And that's before taking inflation into account. Even moderate inflation slowly chips away at the purchasing power of idle cash. So while your balance might look stable, its real value is shrinking over time. That's the hidden cost of holding too much cash. It's the opportunity lost by not investing that cash and having it compound. And that's why managing your cash position is every bit as important as choosing your investments. When dollars sit on the sidelines and they miss out on growth that invested money can deliver over the longer term. That's the real opportunity cost of holding too much cash. Lost growth, lost compounding, and a gradual erosion of what your money can buy. It's why setting the right cash target and putting the rest to work is a critical part of a sound financial plan. This begs an important question. How much cash should you actually keep on hand? The answer is a little different for everyone, but here are some guidelines you can refer to keep idle dollars from quietly draining your wealth. A solid starting point is a true emergency fund. While this will differ from person to person, typically 3 to 6 months of living expenses is a good starting point. Retirees or business owners with unpredictable income may want a larger cushion, but beyond that, extra cash just sits and loses value. Next, separate shorter-term needs from longer-term goals. Money earmarked for upcoming expenses like a home down payment, a tax bill, or a planned major purchase should remain liquid and safe. But funds not needed for years typically belong in a diversified investment strategy where they can potentially grow and outpace inflation. This is where a personalized cash flow management strategy matters. Now that we've covered why excess cash can quietly erode your wealth, let's talk about how to put that idle money to work. Once your emergency fund is set and your short-term needs are covered, the next step is to give any surplus dollars a job to do. For money that you won't need for several years, a well-diversified mix of stocks, bonds, and other investments can capture longer-term growth while balancing risk. If you're nervous about committing a lump sum all at once, consider easing in with a dollar cost averaging strategy, investing smaller amounts on a regular schedule to smooth out any market ups and downs. For funds you might need sooner, there are smarter places than a checking account to park your cash. Shorter duration investments like treasury bills, high-quality bond ETFs, or money market funds often pay out more than a standard savings account while keeping your money liquid, safe, and accessible. And for longer term dollars, think about tax efficient opportunities. Roth IRA conversions, tax managed funds, or even contributions to a health savings account or 529 college plan can turn that idle cash into tax advantaged, sometimes even tax free growth that supports your future goals. The key is to move beyond holding excess cash just in case and give every dollar a purpose so that you can reduce your cash drag while staying aligned with your risk tolerance and longer term plan. Of course, the right cash strategy isn't static. It needs to flex with the economy, markets, and your personal financial situation. Interest rate cycles, inflation trends, and market conditions all play a role in how much cash you should hold and where to park it. During periods of higher inflation or economic uncertainty, it's still important to keep enough cash for emergencies, but not so much that your long-term investments stall. That's why regular reviews and rebalancing are key. Your financial plan should be stress tested for different scenarios, falling rates, market volatility, or even a recession. By checking in on your allocations at least annually or after major life changes, you'll keep your cash position aligned with both the current environment and your long-term goals. Here at Towerpoint, we build this flexibility into every client plan, making sure cash management evolves alongside the economy instead of reacting to headlines. We believe smart cash management is every bit as important as smart investing. Our fiduciary approach starts by helping you identify how much cash is truly necessary for your comfort and security, then putting any excess to work in a way that fits your unique goals, tax picture, and tolerance for risk. Whether that means tightening your emergency funds, exploring shorter-term opportunities, or creating a longer-term investment strategy, the goal is the same. Balance liquidity with growth so every dollar has a purpose. If you're wondering whether your cash position is working as hard as it could, we'd love to help. We invite you to schedule a complimentary 20-minute Ask Anything conversation with our team using the link below. And we'll review your current plan together. Don't forget to like this video and subscribe to Towerpoint Wealth channel for more educational financial insights as we post new videos regularly to help you make confident, informed decisions about your wealth. Thank you for watching.